Good morning, Stamford Board of Realtors. How are you this morning? I hope you're doing well. Thank you for joining us again at a webinar. As you know from the last email, we've launched a different series, and it's going to be very short, actually. We're done with navigating in turbulent times, navigating real estate in turbulent times, and now we've moved on into, well, what do we do now that it's a new beginning? So the one thing that came to mind as I was chatting with other realtors, both in Connecticut and in New York, as you know, I'm licensed in both, we said, wow, we had such an influx of renters coming in. And some of them were coming in sight unseen. Some of them were just like, we'll pay whatever we need to pay, just get us out of the city and so forth. So it occurred to us, a couple of us, that you know what? A lot of these renters are going to love our surroundings. We are going to be, as a community, we're going to be warm, neighborly, and inviting, and ask them, hey, why don't you consider living here full time? You're commuting on your computer anyway, so give it some thought. So with that, I'm introducing this morning Housing Development Fund. We have Mr. Kelly Almanzar, Director, and we have Jacqueline Alves, thank you. Jacqueline Alves, who is an Assistant Manager Loan Officer there, I believe. Correct me if I'm wrong. So if I'm going to ask you both to please introduce yourselves, and maybe we can launch onto some Q&A as we get some rapport down, because I've got some launching questions to ask. So Kelly.
Hi, good morning to everyone. My name is Kelly Almanzar. I am the Director of Residential Lending here at Housing Development Fund. I've been with the organization for about 5 years, actually. I think my anniversary is coming up here in June. I came from the private sector, so I have a background with big banks. But when I first started my career in banking, I started with community development and first-time home ownership. So my career has been somewhat full circle, and I've gone back to first-time home ownerships and low to moderate income buyers.
Great, great. Jacqueline?
Good morning. I'm Jackie Alves. I am the Assistant Residential Lending Manager with the Housing Development Fund. I've been with HDF for a little over 10 years. And throughout my time here, I've been a counselor, a loan processor, a loan underwriter, and Assistant Residential Lending Manager.
Fantastic. Welcome both of you to the Stamford Board of Realtors webinar series as we move into new beginnings. The one thing I wanted to bring to everyone's attention, and maybe you both can help chime in on how we can help our, excuse me, our renters. From March 1st, 2020 through the end of April 2020, across all price points, 178 residential rentals were closed, meaning consummated. Of those, from $0 to $3,500 monthly rent, 155 rental opportunities have closed. So one can't help but stop and think, of these folks, how many of them would probably rather buy and own something? And now within that price point of $0 to $3,500, we have a nice array of folks that could use some down payment assistance, could use some of the benefits that you folks have here at Housing Development Fund. So I'm going to ask you to please talk to that a little bit. But I guess a more pressing question prior to that, just as a community as a whole, is the pandemic has really hit a lot of industries. And folks are always wondering, how well funded are you? How are you able to proceed and do business? You guys are reliant on Fed monies, city monies, municipal monies, whatever it is. So Kelly, if you can talk to us about first the funding aspect of HDF and how you're able to help folks in terms of getting their first home.
So great, thank you. Great questions. Let me start with the funding aspects and why we think that we're very stable. So like a lot of nonprofits, we do rely on city agencies, grants from our partners, from larger nonprofits such as NeighborWorks. I think what's really unique about us is that our premier product, our Smart Move product, which allows for 20% of the purchase price of a property and as down payment assistance at a 3% interest rate over a 20-year term, is capitalized in part by us, but also by our partner banks. We work with 19 banks here in the state of Connecticut, and they capitalize that pool. And the reason I bring that up is because it's very stable, right? We're not relying on government agencies, especially now where there's a strain on government budgets. We're not relying on anyone else and any other agencies to provide funding for us. We participate in it, we fund it, and we fund those funds along with 19 other banks. So it's very stable in that sense, and we're able to conduct business with it. Some of your points, Victoria, with where renters are in terms of the price point, when you stop and think about it, you said $0 to $3,000. Let's take a number there in between, about $2,500. That's about a $450,000 property value. If you know, at $2,500, great price point. As many of you may know, the lending that we do is income based. So I always talk about something called the Goldilocks zone, where you have to have enough income to qualify, but you're not over income. Here in Stamford or Fairfield County, the income limit is $119,000 for the household. So that fits perfectly for someone who is paying $2,500 of rent. They can go very easily and find a $450,000 condominium or single family house that would, and oftentimes, be cheaper than they would be renting. They have the, you know, the advantage of home ownership, the pride of home ownership. They have the ability to do tax deductions with some of their interest payments. And then they have the other added value of appreciation of value. That doesn't happen in a rental situation. You're paying rent. The person who's appreciating the value of it is the landlord of it. And when we look at the marketplace today, I think down payment and closing cost assistance will be more important than ever. When you think of people right now that are tapping into their savings just to survive, to do moves because they have to pay broker fees or pay food or pay whatever expenses they have right now, or hours that have been cut, I think the access to funds will be the most difficult thing to get right now. So I think we're in a great position as a organization that helps with down payment assistance to really be able to help a lot of people, because I think we'll find that people have jobs, have the credit, but just haven't had the opportunity to save up the funds for down payment and closing costs. So I think that's what we're going to end up being, a really good partner to people, and to a lot of realtors who are working out there and trying to get people into their first home.
Terrific. You touched on one word that resonates in my mind. Yes, they have the income, but not too much of it. They're still employed. What about in terms of credit? You mentioned credit. And, I don't know, how does that work? What if somebody is renting because, I don't know, maybe they had a short sale 3, 4, 5 years ago and it's still on their credit? Is that something you work through, or how do you do that?
Absolutely. So we're extremely unique, and I always tout this, that there's a very human element to how we underwrite. None of our files that we do on our Smart Move product, Live Where You Work, or any of our products are done through an automated system. So if anyone's familiar with the mortgage market, usually Fannie Mae and Freddie Mac have an automated underwriting system that they run through. So it just takes a look at numbers. It's an algorithm. Here we're actually looking at a file. So we have the ability to take notes in from that client and see what specific situations happened to those person. Was it a short sale? Was it a short-term furlough, whatever it may be? And we have a committee in place. I mentioned before that we work with 19 partner banks. Each one of those partner banks has a committee representative that can actually take a look at that file and make exceptions on a case-by-case basis. One of the questions I get asked all the time is, do we have a credit floor? We absolutely do not have a credit floor. We're looking for people to work with people who have decent credit profiles, obviously, and we have exceptions that we have in place. And the fact of having that loan committee gives us that flexibility to be able to work with people who have 1 or 2 dings on their credit report, need a little bit of assistance, and we can work with them. So I think we're really unique in that sense, that you hear that a lot about organizations being able to work with the people and not just the score. I think when it comes to us, I think it's true that we're able to take a holistic view of an individual and not just look at a credit score or a debt to income ratio.
Terrific. Very good to know. You mentioned Smart Move, and I have your flyer here, so I'm going to refer to this. You've got Smart Move Connecticut. Smart Move is a 3% interest rate. Is that a fixed rate? Does it float? What if what if rates go even lower? I don't know. I mean, how do you manage that on the processing on the loan side?
So we've had the Smart Move product since 2004. Is that right, Jackie?
Correct.
Yeah, 2004, we've been funding Smart Move products. It's been 3%. It's always been 3%. I foresee it always being at least 3%. It's a good price point in terms of, like I said, we capitalize through our banks. There's not a lot of margin in it, obviously. We have to pay servicing on it. We've done a really good job of keeping it at a low rate, and it's always been at 3%. And I always talk about that. It's been 3%, it is 3%, and it'll always be 3%.
Fabulous. I have a question that just popped in. Actually, you answered one earlier, but in the event we missed it, I'll ask it again. But question number 2 comes in. You mentioned 119,000 income. Is there anything available for folks making anywhere between 60,000 to 100,000? It sounds like a sweet spot.
Sure. So let me clarify that. What I meant by 119,000 is that the income cannot exceed 119,000 to be eligible for the programs. If the income is lower, obviously you need a certain amount of income to qualify for a particular purchase price. So if it's less than that, that's fine. So if you qualify for a $300,000 condominium, based on $80,000 of income, that's fine. You're still under the income cap of
Mhm.
119,000. So as long as the household income does not exceed that 119,000, you would be eligible based on whatever income you need for a particular purchase price.
Terrific. You know, we have UConn in our surroundings, and we have a lot of those graduates that eventually come out and they rent, and then they go to work and so forth. But there are times when a few years ago, I got a call from a young man, and he was very, very astute in terms of what he wanted to do with his future and how he's going to manage his money. And he said, listen, I'm going to rent now, but I want to buy a 3-bedroom condominium. I'm going to rent out those 2 other rooms, and I'm going to have it pay for itself. I'm going to establish equity. I'm going to move on and create some degree of wealth equity, or I'm sorry, generational wealth.
Mhm.
And I thought that is brilliant.
Sure.
So does that audience also qualify for your program? They're not earning over 119,000, but yet they're not, at 60, and they're just starting out.
So they're actually the perfect artists because they're probably earning under 119,000. So they're once again they're under that cap of where we need them to qualify.
Good.
We actually skew towards a younger audience. Jackie, if you don't mind, I'll bring you into the conversation here, and I want to bring Jackie in because she was a
Good.
counselor. She's kind of a jack of all trades for us. She's done counseling. She's done underwriting processor. So maybe
Wears many hats.
many hats, and you find that having to do that at smaller organizations. But Jackie, maybe you can talk a little bit about cases like that where you've kind of seen a younger audience with us, and maybe a success story.
We absolutely have more of a younger audience, especially now in this day and age, and a lot of people coming directly out of college that are looking to purchase, or that are young professionals just starting in their career. We normally look for a 2-year work history. However, we do accept transcripts if we know they were a full student, things like that. We want to work with them. We want to build our communities. We have a couple of different loan programs, including the Live Where You Work program for down payment and closing cost assistance. And with that one, we specifically try to keep our borrowers within the community where they currently work, and kind of living and working in the same community builds more of an establishment and more of a reputation for the community.
Fantastic. You just hit on something, down payment assistance, and a question comes in. Are you offering down payment help as a loan, as a gift? Is it ever paid back if it's a loan? And if it's paid back, at what rate and how is that managed?
So we have a couple of different variations of products right now. I would say all our products right now are loans. In the past, we have grants, which are forgivable. Right now, we don't. Our 2 main products are Smart Move, which, as I mentioned before, is a 3% 20-year amortized loan product. So obviously, you make monthly payments on it based on a 20-year scale at 3% interest. The other product that Jackie just mentioned before which is the Live Where You Work product. Those are products we call silent seconds. And what I mean by that is that it sits on lien position, it sits on a title of a property, but there's no payments for you to make on it. Those loans are up to $20,000, but while you're in the property, you make absolutely no payments on it, and there's no interest or accrual on it because it's 0% interest. It would be due back to us at sale, refinance, or transfer of the property. And what we do with those funds is that when we have a borrower that's taken advantage of it, been able to be in their house 5-10 years, and now sells and move on to the second house, once we get paid back those funds, we lend it to the next person.
Very good. Quick question, actually, back to the example that I came up with earlier with this young man who wanted to rent out 2 of the bedrooms in a future 3-bedroom condo and have it paid off. Is that doable? Can he say, I'm going to rent it out, I'm going to buy it, I'll live in it for the year, then I'll move out, I'll keep title, obviously, and I'll use it as a rental because, I don't know, I'm going to get married or I'm moving on or whatever, but he's not transferring. Is that still something, that a vehicle he can look towards if that's his plan going out a year, 2 years?
So Jackie, why don't you talk a little bit about income for underwriting standpoint and what we allow, what we don't, and maybe we could talk a little bit about multifamily as well, because that's an investment opportunity.
So for a single family, if he was renting out bedrooms in his home, we obviously wouldn't use that additional income as part of his income. In a multifamily, we would use the additional rental incomes for their income. We do require the homes to be owner occupied, so he would have in the home for the life of the loan. However, we will accept, we do realize that people do move on, and then at that point they would have to either sell the home or transfer the title.
Okay, but you don't go knock on the door to find out. You don't knock on the door to make sure they're there, do you?
We do not.
On our system.
So I suspect Jackie wouldn't mind if I sent her out on a sunny day to go do that. But let me just add one thing to that. So we actually have a specific, now that we talked about multifamily, we actually have a specific program for landlord entrepreneurs. It's called LEAP. It gives you the ability to layer other loans around it, so you can use the Smart Move loan on it. And it specifically has a built-in component of $10,000 for down payment and closing cost assistance, specifically for multifamily. So that's a really all-in-one encompassing solution, because we have the solution where we can do a Smart Move with the 80% first mortgage, 20% on the second mortgage, 100% financing. But then sometimes the donut hole is, well, I just need the closing costs. That's a great solution, because in that program, if it's multifamily, you have 80% financing for the first mortgage, 20% on our Smart Move second loan, 100%, and then we provide you another $10,000 for closing cost assistance.
That's terrific. That's the launching pad to generational wealth.
Absolutely.
So we're not just giving funds for them to enjoy a home, but also to establish a future for themselves, their children, and so on. That's terrific. That's like a Napoleon Hill type of venture. Yes. I love that. I have a question that came up, and I don't know, maybe Jacqueline can answer this. How many loans do you approve every year? I mean, what's the application pool look like and the success rate?
Final numbers, Kelly, do you have them for this quarter?
It depends on product. In terms of home ownership, so total products that we do to help and assist in one way or the other. So that might be Smart Moves, Live Where You Work, the program or the Landlord Entrepreneur product that I mentioned today. In one way or the other, we help anywhere. I think the number last year was about 400 households that we were able to help. So somewhere around 300 to 400 households.
That's fantastic. We have 155 folks that have rented in the past 2 months. Mm-hmm. So you could at least cover all of them. I love that.
Absolutely.
It would work very, very nicely. Another question, how long, and I think we might have touched on this, but if you can elaborate, how long does a buyer need to live in the home before they're able to rent it, or are they allowed to rent out the property? I think we might have touched on that there's some degree of flexibility there.
I'll punt that to you, Jackie.
Yeah, correct. We do have an owner occupancy requirement. Like you said, we're not checking up on people, but same as Chaffo, we do have an owner occupancy requirement.
Terrific. And now, is this only for first-time home buyers, or could they purchase a home and then they need to upgrade, and then 3 years later they say, you know what, I'm not making that much more, but I'd like to have a larger home, and they haven't owned something else in, say, 3 years between that time. Can they still qualify?
Great question. Yes, we use the HUD definition of first-time home buyer, and by definition, that's 3 years removed from a home ownership interest. So we saw that a lot post the Great Recession, where people unfortunately may have lost their home, weren't homeowners, and they came back into the marketplace. So by definition, as long as they were 3 years removed from home ownership, they would qualify as a first-time home buyer.
Oh my God, this is terrific. Mm-hmm. Terrific. Now, also, you said that you mentioned earlier that you have a counseling program. How does that work before one is even through the door and saying, I want to fill out an application? Is there a counseling program you take them through to, I don't know, financial education, how to manage a loan, how to manage a home? What is it you do with them before they get to the application process?
Jackie, I'm going to lean on you for your counseling background.
Sure. So we do a counseling aspect. That's part of us that makes us unique. We do require all of our borrowers to have first-time homebuyer counseling and education. The first step to becoming a client with us is to start with our counseling. Once you meet with the counseling, they assess you for mortgage readiness and eligibility. So if anybody had any of those credit issues or they were concerned about their credit, the counselor would review their credit with them and allow them to kind of give them guidance as to what changes may need to be made, or if they are okay, and kind of things like that. They'll also talk to them about their savings, their budget, and they go through the whole loan process with them. So they give them a breakdown of step-by-step processes, what's needed, what they can expect, what to look for in inspection and appraisal and things like that. So it's a full detailed counseling. Mm-hmm. And they have a one-on-one with their counselor that lasts about an hour. It can be done remotely. And so a lot of times they're doing them through Skype, over the phone, Zoom sessions at this point, whatever, works for the client. Once they've done that, and they are also required to take a higher education class. And that is given through or online. They have the option to do it. And this way we kind of set them up for sustainability of home ownership. And all that needs to be completed prior to purchasing the home.
Great. And do you have, at some point, do you sit down with them and educate them on how to work with a realtor? Because many of them have not talked to realtors outside of the rental process. And that's a, wham, bam, thank you, ma'am, I'm done. Give me the keys, I'm moving in.
We kind of give them sort of like a cheat sheet throughout the 8-hour class has it, as well as our red folders that we give them full of information. It's just kind of basic questions to where you should start when approaching a realtor and looking for a realtor.
Terrific. So now they've gone through the counseling process. They're filling out an application. They're looking at the options. You have the Live Where You Work, Smart Move, the Landlord Entrepreneurs. I didn't know you had that, so I'm very interested in that going forward. What does the application process look like? What do they bring? Is it a standard type of process where they bring in their W-2s or 1099s, whatever they may have?
So it would be very familiar to whatever they provide in terms of first mortgage lenders. The things that would be unique is that you mentioned it before, we're looking to make sure that they weren't homeowners for the last 3 years. So generally speaking, from the banking world, you're looking for 2 years of tax returns. Here, we're looking at 3 years because we want to see if there was that deduction on their tax returns 3 years ago to show that they were homeowners. Is there anything additional, Jackie, that you could think of?
The only thing additional is we do require an inspection to be completed.
Right.
So most lenders don't require an inspection. We do.
And let me just add to that. The reason we have that inspection requirement, there's a model we go by here a lot, is that we're trying to create successful homeowners and not just homeowners. And the reason we require the inspections is we want to make sure that you're getting into a property that is stable and you're not going to have a lot of expenses that you had no idea were coming up. We work with a lot of borrowers that are basically using all their savings, don't have a lot of cushion. So we want to make sure they're in a stable position, that they don't have unexpected repairs that are coming up. So that's why we require the home inspection. So it's an advantage and a protection for the borrower.
Terrific. So you have a candidate sitting in front of you, husband, wife, and they're trying to, buy their first home, or it could be a single person trying to buy their very first home because now they're working here. They were studying, I don't know, in Idaho, they're in Stamford now. Listen, they say, my mom wants to help me with $100,000. How do we work that into the formula? Because I'm still not earning over $120,000. I'm over $60,000. What can you do if my mom's going to help me with $100,000, $50,000?
Well, the advantage to that is that the larger the down payment, the smaller the payment would be. So clearly, if they're having trouble to qualifying from an income standpoint or debt to income standpoint, the more money you put down on it, the smaller the payment would be. So that would be fantastic help. In terms of us allowing it in the transaction, we allow that as a gift. A lot of our transactions, I don't think I'm talking out of school here when I say, Jackie, I would say maybe like 50 or 60% of our transactions have some type of gift funding involved where it's a family member. So we're comfortable with it. We allow it. And it's only benefits to the borrower because A, that means that they have equity in the product, 2, that idea of creating a successful homeowner, and it brings down their monthly payment.
That's phenomenal. Now, what about credit? Kids that are coming out of college and some of them grad school, they have a credit card. They've used a little bit of it, but there are others that have been very, very shy about the full utilization of that credit card, and their credit's a little light. They're not delinquent, they're just a little light. What do we do with that?
Jackie, maybe you want to talk a little bit about alternative credit
and the minimum credit that you were looking to work with.
Mm-hmm.
As Kelly mentioned, we don't have a credit floor. We generally go by the first lender's guidelines. So whatever their guideline is for that loan product, we would have to adhere to that. We don't have our own separate overlays. We do accept a non-traditional credit. And as Kelly stated before, we're also manually underwritten. So we do accept exclusions as well. If a client doesn't have non-traditional credit, such as a utility bill, a telephone bill, we've done things even as far as Netflix accounts, just something that's
whatever works.
Correct. They don't have those. It's still not an automatic denial. They can submit letters of explanation as to why, whether they were living at home and have no utilities in their name, things like that. Just as long as they can explain and we can verify, we're willing to move forward.
Terrific, because there's also a sector in the market that we're underestimating right now. It's a change in marital status. So we're going from the married to the non-married or the separated, and well, one of the spouses is not going to have all the documentation because it was under the name of the other spouse. So how do we look at that?
Jackie, I know you have experience with that from separating spouses. Can you go over that?
So correct. So we would need, if they were separated, we would need paperwork stating that they're legally separated. Majority of paperwork that we require would be things as far as tax returns in bank statements, which can be provided online. I don't know what documents they wouldn't be able to achieve with due to this. However, we would require that they would show papers of legal separation prior to moving forward.
Okay, terrific. I think I have a question just popped in. Okay, it's one that we answered earlier. How long do they have to live in the property? Okay, I know I have all your flyers here. So for the audience, I'm going to go scan these flyers in for those of you that have not received this, because we did a presentation back in the winter, I believe. I'm going to have these uploaded for you guys to look at, but I'm going to just hold it up. So here's the live where you work flyer that I'm going to put up online. Here's the Smart Move Connecticut. And these are terrific because you can take them and include them with your mailings and send them out to those renters that are currently there and entice them to come to market and buy something. If they just rented, then the chances are they can very well start looking for their future purchase now, because it's going to take them time to get through the program. And you guys can help me with the timeline on that. And from the real estate perspective, it's going to take them maybe 3 months, 4 months to look for something, and then another month and a half to close it. So it's a great opportunity to start knocking on those doors, those 155 people that have rented from 0 to 3,500. Yes, I will get these in PDF, and Kelly, if you have them in PDF, if you want to give me a hand, fabulous. Otherwise, I'll scan them in. So another question now, you mentioned about the loan, which is, this is the live where you work, and it's subject to a loan fee of $750. I see that here. Folks in this budget range, they're very, very, very concerned about how much they're going to spend, and they want accountabilities, like how much money do you want from me, how much more down payment, what other fees are involved. Are there any other fees outside of the loan fee? Is there a fee that's associated with the lender that they choose to work with?
So the only other fees will be at the end of the day, it's a mortgage, so it does have to be recorded. The other fees that you'll see with it would be normal in any other normal loan transaction. So it does have to be recorded. So there would be a local state recording fee. The attorneys charge a settlement to close it. Sometimes they do it as a bundle if they're using 2 or 3 of our products at the same time. If it's standalone, obviously they'll charge a fee for that closing. But generally, it's the recording fees, a settlement fee. Anything else I'm missing, Jackie?
Normal things of flood certification.
That's right.
Okay. So the standard.
Correct.
Okay, so we as realtors can educate them on that. Now, if they can't do 20% down, 25% down, and your $20,000 only takes them a certain distance, is there a PMI they're going to incur when they start going through the loan process?
Well, here's the beauty of our product. I mean, you can work it however you want. So let's say, you got that live where you work and you got 20,000, but that doesn't cover the 20% down payment. Then you can use Smart Move to kind of fill that gap in essence. So if you wanted to do, let's say, I mean, I don't know how many people are traditional of 80-10-10 financing, which would be, let's say, 80% primary mortgage. You could do a 10% Smart Move. Remember, when I say Smart Move, it's up to 20%. So whether that's 5%, 10%, 15%, and then you can layer it in with either Live Where You Work, which is up to $20,000, or Stamford Home, that's up to $20,000. Remember, here in Stamford, if you can qualify for Live Where You Work in Stamford Home, that's $40,000 that you can layer there into the transaction, where there's no interest and no payments while you're in the property. You can also layer Smart Move in that transaction to avoid the PMI.
That's fantastic. It just sounds like a fabulous thing. Folks, if you could please use the Q&A and not the chat, I really would appreciate it, because I just figured I'd take a peek in the chat and I see some questions in there. Here's a question. If an applicant has a job but is collecting unemployment due to the stay-at-home order, can they still qualify for that loan? That's a great question, because a bunch of us know folks that have done the unemployment, some of the PPP, some of the PUA, and every other acronym, the EIDL acronym, and every other benefit that's out there. How can they still qualify?
Jackie, do you want to handle that, or you want me to handle it?
Well, I mean, we would still use their income if they're still having a job, obviously. We would probably look for additional paperwork either from their current employer, just stating that they would go back to a full-time position or whatever for the future. I don't know that we have kind of set guidelines yet as far as what we're doing with the additional unemployment stimulus package, if we're using that as income or how we're going to look at that.
Let me just add to that topic. That's probably going to be a moving target, I would think, for all lenders right now. There's going to be a lot of disruption in income, obviously. A lot of these people are not, you look at what's going on right now, a lot of people are not out of their place from work right now. So their jobs are there and they're waiting for when we open back up. So there's probably going to be a lot of guidance. We generally follow whatever secondary market Freddie Mac, Fannie Mae are doing, but I'm sure there's going to be a lot of guidance with it. Historically speaking, unemployment income is not qualifiable income towards a mortgage unless it's something that's seasonal, where every year they get the unemployment. Generally speaking, when someone's out of work, it's not qualifiable towards a mortgage. I would think that a lot of that's going to change right now, because that's not really the circumstance right now. Right now, we're kind of using unemployment and the enhanced unemployment as a kind of a Band-Aid to kind of get people to where we can open up again and work. So I just wanted to add those points from an unemployment standpoint, that I think that's a moving target, and some things will be changing with that. And we'll be quick to adapt with whatever's happening in the secondary market.
You know, it's funny you say that, because a lot of folks consider our businesses as moving targets in terms of when we emerge. And we're, as realtors, we're getting ready, which is why we have you. We have a very special guest speaker coming next Friday. And yeah, folks are doing that. They're like, we're moving targets. We don't know where we're going to go, but we're going to take it one day at a time.
Yeah.
We are resilient individuals, resilient community, and we'll get there. And that takes me to the next question as to how we're going to get ourselves moving. In terms of your office, how are you taking these appointments? Are you doing them in your office? Are you doing Zoom? There's a certain quality that literally dilutes itself when you only see them on Zoom. And I trust you. Trust me and you. We all want to be together again, but business has to be conducted in any way we can do it. So how do you do it?
So the first thing message I want to get out there is that we are up and running and fully operational. And to add to that as well, we are, I think the thing that you're seeing in advertising all over the place is we're contactless, if you want to put it that way. You can do everything contactless with us. The first step with us is going to our website. There's a tab there to start your journey, and that's where you start everything. So everything's online. From that point on, you can upload documents right online with us. You can have an online consultation via phone, via Zoom, like you mentioned before, with the client. But everything can be done remotely at this point. We are available, whether that's from a counseling standpoint, that counseling can be done via phone, can be done via Zoom. And then from a lending standpoint, we're 100% operational in terms of that. We can do our remote closing, underwrite, processing, collect documents from our clients all remotely.
That's fantastic. So what if a person doesn't have the technology readily available to submit to you? I mean, I guess they have to figure it out, take a picture with their phone and send it up.
So we actually have guidance. We have some apps that we use where you can actually convert pictures into PDFs, and we're happy to share that with clients if they don't have access to technology. We will have offices opening, so moving forward, if someone needs to come in and we'll have the ability to do that. I think that's happening within the next week or two, and a lot of businesses are going to be slowly opening up. And outside of what's happening right now, generally speaking, we have worked with partners throughout the state to be able to do that physical presence. Like you mentioned, some people like to just see someone and sit down with them. So we work with partner counseling agencies, where they can actually take documents for us and act as a conduit like us, and take documents and submit it directly to us.
Great. What if there's a person that's linguistically challenged and English is not their most proficient, and they'd rather do Spanish and feel comfortable? Because it is a big deal. Buying a home is a really big deal, and they want to have that sense of comfort that I fully understand everything. Can you speak my language?
So we have counselors on staff that are bilingual, English and Spanish. Myself, from a lending department, I'm bilingual. I speak English and Spanish. Jackie speaks Portuguese, I believe, correct? English, and then we have a couple of other staff members in the lending department that are also bilingual, Spanish and English. And like I said, we also have that support from a counseling standpoint. And we always want to increase the comfort level. I've dealt with some people who can kind of, I would say, defend themselves with English, but just feel more comfortable talking in Spanish. And we always want to deal with them so that they understand the process, they feel 100% comfortable. And if we need to pull somebody from some other transactions into that transaction so they can interpret or have a better dialogue with them, we're always happy to do that.
That's phenomenal. Folks, we're running close to our scheduled time here. So I wanted to ask you, you mentioned earlier that you're working with, is it 19 financial institutions?
Correct.
Okay, do you want to just give us off the top of your head and email me, and I'll put them onto our site later, onto the YouTube site?
There, I will definitely email it with you along with the PDF of the flyers. They are on our website as well. Some of the ones off the top of my head I can go. We work with large lenders and small lenders. So some of the larger ones we work with is Citibank, People's United, First County Bank. We work with smaller community banks such as Savings Bank of Danbury, Fairfield County Bank, Union Savings Bank, Any that you can rattle off, Jackie?
Newtown Savings Bank, Liberty Bank. Trying to think here.
What about credit unions?
Historically, we haven't worked with credit unions. We do work today with a broker called Norcom Mortgage. They're up in North Connecticut. We don't work with we haven't historically with community credit unions, but we do work with a broker today.
It's good to know. It's good to know. So it sounds like a lot of the lenders that we work with on a day-to-day basis, so we already have relationships established. It's just a matter of getting those folks that are renting and talking to the lenders and speaking with you.
Yeah, I would never think that, generally speaking, doesn't happen where someone is not able to work with us because they're stuck with another lender that's outside of us. We have a very robust network of lenders.
That's good to know. Folks, is there anything you want to give us in terms of information from HDF that I would have not asked and our Q&A has not prompted? Anything we need to know that we don't know that you want to volunteer?
I would just state that, you know, our counseling is a great asset. It's something that's required of all of our partners. It is, they can start counseling at any point in time. They don't have to have an accepted offer. This just kind of says if they're mortgage ready and if they're eligible for our programs. There's no obligation for the client to use our products once they've gone through counseling. So it's a good stepping stone to get any potential borrowers that you have prepared for purchasing a home so that they have a better idea of what they're looking at and their options.
And the counseling is a requirement, if I'm correct.
Correct. It's a requirement for our loan, but it's beneficial to anybody in general.
Okay, fantastic. Good to know.
Let me just add to it something that Jackie said. Use us as a resource, use us as a partner. And what I mean by that, especially if your point in terms of working with a lot of people who are transplanting in Connecticut now because they're renting. Those people may not be ready to be homeowners right now, so they may have credit issues or whatever it is. You can use us almost in essence as someone that helps you create your pipeline because we work with borrowers who may not necessarily be ready, and we get them ready. So they may be 6 months away, 12 months away, maybe even 18 months away from home. So one of the questions I get asked when I talk to do presentations is it ever too early or too late to work with HDF? And the answer is always no. It's never too early. If you're working with the borrower that's a little bit of assistance that won't be ready for 6 months, send them over. We'll get them over that threshold. Even if they're in the midst of a transaction right now, and now you've discovered that one of our products may be eligible for that person to use, we can always jump into that live transaction. So it's never too early and never too late, and we are 100% operational at this point.
Just like working with realtors, it's never too late to give us a call. Never too early, never too late to call us. We're up and running 24/7.
Exactly right.
We're there. Good to know. Kelly, thank you very, very much. And seriously, we're definitely going to be reaching out to you. It's a great product. Generational wealth can be established. Folks are always wondering, oh my goodness, I'm only paying rent. Well, here's an opportunity to own a home, establish equity, again, generational wealth. So the realtors out there, I think, we've got 155 doors we can go knock on and introduce them to HDF and try to get them on board. Jacqueline, thank you very, very much. And Kelly, before I let you go, if you can please give me your phone number and your email for the audience.
Sure. So phone number is 203-883-5191. Email address is kalmanzar@hdfconnects, CONNECS at the end, .org.
Terrific. Jacqueline? The phone number is 203-916-4020. And my email is jalves@CONNECTS.org.
Terrific, folks. Thank you very much for hanging with us this morning, for educating us on what your product can do to help us with moving people forward. And we look forward to speaking with you really, really soon. For my participants out there, you can just hang on there for just a little bit for some housekeeping. That would be great. Again, just a reminder, we're going to have the PDFs uploaded, courtesy of Kelly. I will have a YouTube clip of this also put up later today. I need to edit. And we will be able to put the links on there for you to reference. Okay. Again, Kelly, Jacqueline, thank you very, very much for being with us. Realtors, hang in there for just a little bit. Bye, Kelly.
Thank you, Victoria. Bye-bye.